Hey investors, welcome to this episode of Invest You. Today we're going to be doing an analysis of the Clorox company. So Clorox has quite a bit of buzz because of COVID-19. So primarily we know them for their Clorox wipes these days and their cleaning products as well, but they do carry a wide variety of products both in the cleaning and household divisions. And some of the brands that you'll recognize are Glad, Brita, and Pine Sol as well. And we'll get into some of the other business streams and how they impact the revenue throughout this video. Okay, some basic stock info for the Clorox company. The ticker is CLX. It's traded on the New York Stock Exchange. This analysis was performed on the 8th of May 2020. It presently has a market cap of $25.4 billion, a stock price of $201.99, and 126 million shares outstanding. I've posted a copy of our investing rules here, and they'll be included in the show notes below. And feel free to head over to valueinvestu.com to check out some more information on investing. So digging into some key metrics for the Clorox company. The price right now is $201.99. It has a 2508 PE ratio, which is a little bit higher than what we're hoping for from a value investing standpoint. The earnings per share of $6.82 translates into about a 3% return per year. It has a 2.15% dividend yield based on the price at the moment. The price to book is not great. It's 34.9, which translates into a margin of safety of only 2.8%. So this is incredibly low for what we're expecting from a value perspective. So we'll have to dig into why this may be and do some comparisons with other companies in its industry to see if there's an issue here. Debt to equity is on the high side of 8.15. Return on equity is good, though. They are an efficient company. It's 15.8%. Current ratio is lower than we want. We're looking for something around 1.5, and this has 0.91. And the EV over EBITDA suggests that this price is overpriced at the moment at 19.7. It does have a lower correlation, however, to the S&P 500, so this is a good company to add to balance out your portfolio, especially if you have other stocks that are more correlated to the S&P 500. And they do have a lower correlation to a couple of other stocks that we've done some reviews of, Walmart and Tesla specifically. Looking at the value over time for the Clorox company, we'll head into the annual report and look at how they performed in 2019 and previous years. From a revenue perspective, we see steady revenue growth year over year. We also see steady net income growth year over year, which is a positive sign. The total assets are trending upwards, as are the liabilities, however. And we are seeing an increase in debt. I would say, though, there is a benefit here where we are seeing a decrease in shares outstanding. And they do mention in their annual report that they are actively buying back shares on a year-over-year basis. As a result of some of the increasing debt and liabilities, the total shareholders' equity is changing quite a bit. We see some peaks and valleys here, so that seems to be a bit unstable. The debt to equity is improving all in all, so that is a positive thing. The current ratio is a little bit lower than we were expecting. Again, we're looking for something around a 1.5, but they're consistent kind of around the 1 marker. And so we'll do a comparison to its industry peers to see if that's out of line with what the rest of industry is doing. Consistent earnings per share growth and a consistent dividend payout for many years, and we'll take a look at their coverage in the next few slides. And in general, good book value growth as well over the years. Okay, we'll compare the Clorox company to a few of its industry peers here. From a dividend yield perspective, I'd say it's in line with its peers, maybe on the lower side of things because it does have quite a bit of buzz for the price at this point in time. It has an average PE ratio. There are a few companies out there that may have better value from that standpoint. Kimberly-Clark Corporation is one of them. Spectrum Brands Holding has been one that's been on some of the value tickers that I've looked at recently. They're not reporting a PE ratio at the moment, so perhaps they've had some negative earnings recently that's impacted them. Return on equity is quite high. It's probably in line with the top quartile there. So from a price to book perspective, it is quite high relative to its industry peers. A large reason for this may be the fact that the stock has inflated 30% since February when we had an issue in the market with COVID. So I suspect that it's going to have some positive buzz over the months to come. It's had very strong performance in the Clorox wipes and cleaning division, and I suspect that's going to continue over the next few quarters. Current ratio is a bit on the low side, as is the quick ratio, and the debt to equity ratio, we will see through companies in this type of division that it is on the higher side. As Clorox is a company that's focused on paying dividends, we want to make sure that they have sufficient coverage to pay out their dividends. So in order to do that on a quarter-by-quarter basis, we'll look at the earnings per share and the dividend payout relative to the share. And we see very, very good growth of the dividend over time. And we see good coverage of the dividend over the past few quarters. So it looks like they have a healthy balance sheet and they're able to cover their dividend payouts that they have. So I've done two methods for doing an intrinsic calculation for the value of the Clorox company. One is a simple discounted cash flow approach, and the other one is a book value growth approach. So the growth I'm looking at from a revenue perspective is about 7% over a 10-year cycle. We discount this at 10%. The growth rate in perpetuity right now is 2%. And using the 2019 free cash flow, I arrive at, with a DCF intrinsic value of 100.11. And using a simple book value growth approach, I arrive at 183.85. So that kind of suggests you're probably in the 150 range for this company from an intrinsic value perspective, somewhere kind of in that area. Right now, we are priced just slightly over 200, so it would suggest that the stock is overpriced right now. However, it probably is carrying some good momentum because of the revenue it's had over the past few months and the continued demand for the product during COVID. Okay, let's dig into the annual report to look at a few negatives and positives. So as mentioned, there's a significant demand for the cleaning-based products during COVID-19. Cleaning products account for 34% of the revenue generated in 2019. A couple of other areas we'll dive into in a few moments, but there are some other products that generate significant revenue for the company. From looking at the last quarter's report, it had a 32% revenue increase for the cleaning products specifically. So if we look at what that impact is going to be, I would suggest it would have probably a 10% impact on the revenue for the company at this point in time. The demand could increase. I know they're trying to keep up with demand for the wipes. So as they increase capacity, the revenue may increase in this area, and we may see something that grows much more than 32% in the next quarter. No material disruptions reported yet as a result of COVID-19. Nearly 80% of the company's sales is generated from brands that hold a number 1 or number 2 market share position in their categories, and this is really good for recurring revenue. Comparing 2018 to 2019, there was a 1% sales growth for the fiscal year. The cleaning sales were up 2%, and a couple of brands there are Clorox and Pine-Sol. From a household perspective, Kingsford Charcoal and Glad were kind of their main 2 products in there. Sales were down 5%. Comparing 2018 to 2019. From a lifestyle perspective, a couple of brands you may recognize are Brita and Burt's Bees. Sales were up 17%, and international sales were down 6% overall, again comparing 2018 to 2019. One positive thing, though, when we're looking at 2020 so far, looking at the year-to-date compared to the year-to-date with 2019, and looking at the last quarter we had in 2020 versus the similar quarter in 2019, all segments are showing positive growth through cleaning, household, lifestyle, and international. And as mentioned, cleaning is up over 32% in the last quarter, so definitely trending in the right direction. And as mentioned in the previous slides, they are actively participating in share repurchasing, and we're seeing that the outstanding shares is decreasing over time, which obviously helps our value for our stocks. Okay, diving into some risks or negatives for the Clorox company when looking at their annual report. They recognize they're in a very competitive industry across a variety of sectors. One of the main disruptors is private label brands coming in and taking away their market share and taking away space on shelves for some of their key customers. They do acknowledge that they're sensitive to changes in commodity prices, energy and transportation costs. If they go up, that would adversely impact how their products can get out to their customers. And resins and sodium hypochlorite or bleach is also something from a commodity perspective that they use in their products, so they're sensitive to changes in that area. I will say, though, that what we've seen in the energy sector and the transportation sector should benefit them, and we should see a lower cost of revenue as a result of shipping these products around to their customers. Some of their products have seasonal patterns to them. For example, Kingsford Charcoal, primarily through March and September during the barbecue season when it's a little bit warmer. When you look at the quarter-to-quarter revenue generation, not huge swings in terms of the overall patterns, but they do recognize that some of their products are cyclical. They do have a very good, diverse customer group, with only Walmart taking up of 25% of their overall sales. Some of the other larger customers take up 5 to 10%. But the 5 largest customers account for 50% of their sales. So they do need to ensure that they have good relationships with their customers and that they are supplying them stock throughout this tough time. As they have a lot of debt on their books, they are sensitive to changes in interest rates, and the ability to refinance really impacts their bottom line. Maybe a beneficial thing with interest rates declining right now, but they do have $2 billion worth of debt on the books, so that is something that shareholders need to keep their eye on. One positive and also one negative for the company is they have a joint venture right now with Procter & Gamble, and that's focused on the Glad product. And Procter & Gamble has agreed to do some R&D for basically a 20% interest in the Glad series of products. Now, this is coming due in 2026, and the market value of that 20% interest stake, as they have said in their 2019 annual report, is about $691 million. So unless this was renegotiated in 2026, they could pay out something to this magnitude. It may be a little bit bigger, maybe a little bit smaller, depending on how Glad grows over time. But that equates to about 10% of the revenue, since they're generating about $6 billion in revenue at this point in time. So that's a risk that we need to keep in mind, but it also may be an opportunity for the future as well. So again, going back to the intrinsic value, we see that using the discounted cash flow approach, we arrive at 111 cents for this stock, and using a simple book value growth approach, we arrive at 183.85. And as a result, it is underpriced. So I wouldn't pick Clorox for a long-term play. It would be something I would be interested in investing on in a small portion of my portfolio for the short term to see how it grows, especially with good reporting on revenue in the past quarter. I would expect that to continue in the next quarter. And I have a few stocks that are like this. BGS is a good example where their products are rolling off the shelf at alarming rates as we stockpile to support our families through COVID. So this would be something we could benefit on for the short term. But if you're looking at this for a 10-year investment, I would suggest it is overpriced right now, and you could see some fluctuations in your portfolio if you invest and hold for a long period. Thanks for tuning into this episode of Invest You. Please click subscribe below and shoot us an email at valueinvestyou@gmail.com, and we'll send you a copy of our stock analysis program, which helps perform similar analysis on tickers of your choice.